Hey friends, welcome back to the channel. Today we're diving into one of the biggest questions in the world of investing. Is long-term investing smarter or is short-term investing the better way to go for you? It's a choice many people face when they start putting their money to work. Should you sit back and let time do the heavy lifting or jump into the action and chase those quick opportunities in the market? It can feel like two completely different games. By the end of this video, you'll have a much clearer idea of which approach might suit your personal goals and style best. We'll break down the pros and cons of each. Let's get started and figure out which path might be right for your financial journey. But hey, before we jump in, don't forget to like the video and subscribe to the channel if you enjoy this kind of content. It really helps us reach more people and keep creating helpful videos like this one. Thank you. Alright, let's kick things off with long-term investing. This approach is all about playing the long game in the financial markets. It usually means holding on to your investments for an extended period. We're talking years here, often 5, 10, or even several decades into the future. The primary goal with long-term investing is simple: to let your money grow steadily over time. You're not trying to time the market's daily ups and downs. This strategy often includes investing in things like stocks of solid companies, broad market index funds, or even real estate properties. You buy these assets with the intention of holding them for significant growth. You typically make your initial investment and then you mostly forget about it, checking in periodically rather than constantly. It requires a set it and forget it mindset to some extent. As the legendary investor Warren Buffett famously said about his preferred strategy, our favorite holding period is forever. That really captures the essence of this approach. Of course, patience is absolutely key here. You need to be comfortable riding out market volatility, knowing that historically markets tend to rise over long periods. And speaking of patience, show some love and hit that like button if you're still with me and finding this breakdown helpful. Your support means a lot. Now, let's switch gears and look at short-term investing. This approach is almost the opposite. It's all about speed, timing, and capitalizing on immediate market movements. It involves holding investments for a much shorter duration. This could be just a few days, a few weeks, or maybe a few months at the absolute longest. Short-term investors actively try to profit from rapid price fluctuations and specific market events as they happen. They are constantly looking for opportunities. This category includes various types of traders. You have day traders who buy and sell within the same day, and swing traders who hold positions for a few days or weeks. It also includes people chasing news-driven momentum, trying to profit from the immediate reaction to economic reports or company announcements. It's a fast-paced environment. But here's the catch with short-term investing. It demands significantly more time commitment, requires a higher level of skill and market understanding, and takes serious emotional discipline. And let's be honest, it can be much more stressful than a long-term approach. You are constantly monitoring and reacting to market changes. So, if you're someone who genuinely enjoys being glued to charts, following financial news minute by minute, and making quick decisions, this might be your lane. It suits a specific personality type. Oh, and if you're enjoying this video and getting value from this comparison, don't forget to tap that like button. It helps us reach more people like you who are interested in smart money moves. Let's move beyond the definitions and get to the hard facts and figures. What does the historical data tell us about these two approaches? Long-term investors benefit significantly from the magic of compound returns. This is where your earnings start earning their own returns, creating exponential growth over time. Your money grows like a snowball rolling downhill, picking up more snow and getting bigger and faster as it goes. Time is your greatest ally in this process. Consider this: the S&P 500, a common benchmark for the US stock market, has historically returned around 8 to 10% per year on average over the very long term. This growth compounds year after year. Yet, studies and statistics consistently show that the vast majority of short-term traders underperform the market averages or even lose money over time. It's a tough game to win consistently. Why is this the case? Several factors contribute to this difficulty. Firstly, timing the market perfectly is incredibly hard, if not impossible, to do consistently. You have to be right twice, when you buy and when you sell. Secondly, it's easy to make emotional decisions based on fear or greed when trading frequently. These emotional reactions often lead to poor investment choices. Finally, frequent trading means higher transaction costs and potential taxes on short-term gains, which can significantly eat away at any profits you manage to make. Fees add up quickly. Based on the historical numbers and the challenges involved, which one do you prefer the sound of so far for your own investing journey? Long-term patience or short-term action? Drop it in the comments below. I'd love to know your initial thoughts and see what resonates with you. And hey, while you're at it, don't forget to subscribe if you haven't yet. Joining the community helps you stay updated on future videos about building wealth. Investing isn't just about numbers, it has a significant psychological component. Both long-term and short-term strategies test your mental game, but in different ways. Long-term investing sounds simple in theory, buy and hold, but sticking to it isn't always easy, especially when markets get volatile. When markets fall sharply, as they inevitably do sometimes, staying calm and not selling in a panic takes serious discipline and conviction in your long-term plan. It tests your patience under pressure. Short-term investing, on the other hand, requires a different kind of psychological strength. You need to make quick decisions under pressure and maintain emotional control constantly. Reacting too fast to a market swing or hesitating for too long can lead to missed opportunities or costly mistakes. It demands mental agility and resilience. Think of it this way: in long-term investing, time is your greatest friend and ally, doing much of the heavy lifting for you through compounding. In short-term investing, you're constantly racing against time, trying to capture fleeting opportunities before they disappear. It's a high-pressure race. If thinking about the mental aspects of investing is sparking some thoughts for you or helping you understand yourself better, give this video a like. Let me know it's resonating. Alright, the moment of truth. After looking at both approaches, which one is definitively smarter? The honest answer is that there isn't a single, universally smarter strategy. The best approach is whichever one fits you better as an individual investor. Consider your own circumstances, personality, and financial goals. These factors should guide your decision more than anything else. If you don't have the time, energy, or interest to follow the markets every single day, analyzing charts and news, then long-term investing is likely your best bet. It's designed for busy people. It allows you to participate in market growth without making it a full-time job. You can focus on other things in your life while your money works for you. But if you genuinely enjoy market analysis, have dedicated time to commit, possess strong emotional discipline, and can manage risk well, short-term trading can potentially work too. It requires a specific skill set and temperament. However, remember this crucial point: the smartest investment strategy, regardless of whether it's long-term or short-term, is ultimately the one you can realistically stick with consistently for the long run. Consistency is key. A well-executed long-term plan is almost always smarter than a poorly executed, stressful short-term strategy that leads to burnout or significant losses. Find what works for you and stay committed. And hey, don't be a short-term viewer who just watches one video. Hit that subscribe button and join our community so we can learn and grow together on our financial journeys. So, there you have it. Today we looked at long-term versus short-term investing from all angles, the definitions, the numbers, and the psychology behind each. We've seen that there's no one-size-fits-all answer to which is smarter, only the strategy that best fits your personal situation, goals, and comfort level. Choose the path you can commit to. If this video gave you some clarity or helped you think about your own investing style, please drop a like to show your support, share it with a friend who might also find it helpful, and leave a comment below. Got questions about anything we discussed? I read all the comments and do my best to respond. Thanks so much for watching today. Stay patient, stay consistent with your chosen strategy, and I'll see you in the next one. Take care and happy investing, whichever path you choose.